For decades, Japan has been this quiet giant at the center of one of the world's biggest investment strategies, a strategy that moves trillions of dollars across global markets. So let's get into how it works, and more importantly, why it's all changing right now.
All right, so first things first, what even is a carry trade? Let's break down this powerful financial strategy.
Okay, so at its core, the idea is actually super simple. Think of it like this. You borrow money where it's incredibly cheap from a country with super low interest rates, and then you invest that same money where it can earn a much higher return. That difference, that gap between the two rates, that's your profit. That's the carry.
And the process itself? It's pretty straightforward, really. An investor borrows a currency where the interest is basically zero, like the Japanese yen has been for years. Then they swap that yen for a currency with higher rates, like the US dollar. They invest it, and if everything goes to plan, they just sit back and pocket that sweet, sweet difference.
Okay, but here's the catch, and trust me, it is a huge one. The entire strategy hinges on the exchange rate. Sure, you get the gain from the interest rates, but you're taking on a massive currency risk. If that cheap currency you borrowed, the yen in our example, suddenly gets stronger, poof, all those profits can get completely wiped out in a flash, and that can trigger this mad scramble to undo the trade, which can get really messy.
So that brings us to the big question. Why Japan? How did this one country become, for all intents and purposes, the undisputed king of the carry trade, effectively acting as the world's bank for decades?
Well, the whole story really kicks off inside Japan's own economy. For decades, the country was fighting this thing called deflation, where prices are actually falling, which is a real economy killer. The Bank of Japan's biggest weapon to fight this was to slash interest rates down to basically zero. And the side effect of that policy? It made the Japanese yen the cheapest money on the planet to borrow.
And I mean, just look at the difference this made. It's night and day. You had Japan sitting there at 0%, while other major economies like the US and Europe were offering rates of 4, 5%, sometimes even higher. For any global investor, that gap wasn't just an opportunity, it was a giant flashing neon sign.
And the sheer scale of this is, well, it's hard to wrap your head around. We're not talking about a few billion here and there. The amount of money caught up in these yen carry trades is estimated to be in the trillions of dollars. It was like a massive river of cheap money flowing out of Tokyo and funding investments all over the globe. But after all this time, that river is starting to change course. We're seeing a massive shift, what people are calling the Great Unwinding, that's shaking up a system that's been in place for a generation.
So check this out. After decades of holding rates near zero, the Bank of Japan finally made a move. In March 2024, we saw the first interest rate hike in 17 years. Then in January 2025, another one, pushing rates to their highest level in over a decade and a half. This isn't just a small tweak, it's a seismic shift.
So you gotta ask, why the sudden change of heart? Why now? Well, the economic picture inside Japan is finally starting to look different. Inflation is actually coming back. And the big one, wages are finally on the rise. All of this gave the central bank the green light to start normalizing policy, to finally step away from those emergency-level interest rates.
And the impact on the carry trade? It's immediate, and it's huge. Suddenly, it's not so cheap to borrow yen anymore, so that profit margin shrinks. At the same time, higher rates usually mean a stronger yen. And remember that currency risk we talked about? Yeah. It's suddenly a very real threat that could lead to massive losses for investors.
Okay, so this is where it gets really interesting, because this isn't just a story about Japan's economy. A decision made in a boardroom in Tokyo has real, tangible impacts on markets in New York, London, and literally everywhere in between.
And this really gets to the core of the global risk. When this strategy goes sour, it's not a slow, orderly retreat. It's a stampede. You have all these investors rushing for the exit at the exact same time. And when you're talking trillions of dollars all trying to move at once, well, that creates chaos. It creates massive volatility across the entire financial system.
And just think about what that actually means for a second. To get out of these trades, investors have to sell off the assets they bought with all that cheap yen. That could mean a huge sell-off in US stocks or in European bonds, and assets that, on the surface, seem to have nothing to do with Japan's interest rates. But they're all connected.
So, let's pull this all together. What are the big takeaways? First, even tiny policy changes in Japan can have these enormous, outsized effects on the entire world.
Second, the carry trade is the perfect, if slightly scary, example of just how deeply interconnected our global financial system is. And finally, the end of Japan's zero-rate era? Well, it really is the start of a brand new and pretty uncertain chapter for global markets.
And all of this leaves us with one massive, lingering question. As Japan keeps moving back to normal, are we watching the final days of the multi-decade era of cheap money? An era that has pretty much fueled the entire global economy for as long as many of us can remember. The answer to that is going to define the markets for years to come.